Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. Thanks for joining today. I am your host, Joe Mosier. A couple of weeks ago, I had a guest on, Jeff Boyd from the Garden City Co-op in Garden City, Kansas. And towards the end of the episode, we started talking about what the co-op of the future might look like. Specifically, would it be an asset-free or an asset-light model? And I was really happy to finally have the chance to at least sort of brush up against the topic, because it's something that I've spent quite a bit of time thinking about. I know it's something that a lot of other folks in the industry are spending time thinking about. And it begets the idea of looking further down the field, right? We spent a lot of time on this program and in many other ag podcasts out there, dissecting the current problems we have and trying to figure out what producers, what operators, what advisors that serve the producers or the operators can do to help overcome these near-term challenges, and sometimes a bit further, longer-term challenges as well. But this is a structural challenge for the cooperatives. And I thought we ought to use that discussion that I had with Jeff to trigger and ignite a bit more of an expansive exploration of it here on the show. Now, my intention is to share some ideas I have around what the co-op of the future could look like, what it may very well look like, and not so much to articulate a definitive, paint a definitive picture for the future that I think this is explicitly what it'll look like in every one of its minute details, but rather to kind of knock us all off center, get us thinking beyond the boundary conditions of what we've known throughout our careers, what is familiar to us and the producers that we serve, and think about, okay, based on what we will need in the future, what might need to change in the way we do the work. Now, I want to be clear. The ag cooperative model was a rational response to a very specific set of problems. We've talked about it in this show before, so I don't want to belabor it here, but effectively, farmers were price takers on both ends, right? They're price takers on the input side, they're price takers when they sell their agricultural production to market. They were largely isolated from the marketplaces, individual participants by themselves without meaningful volume to command competitive pricing. And so they were largely isolated just locally, but also from those longer chain demand markets. They were largely unable to individually own the infrastructure that connected them to those markets, and a variety of other challenges out there. And the co-ops sought to solve that. And in many cases, they did solve that. And I would argue that it was genuinely an elegant solution. But let's sit here and think about that again. If you think, what were the problems that co-ops were created to address? Right? Just think about that question. Then how did the way they evolve over time reflect those problems they're meant to address? As we sit here today in 2026, we think about the state of the farm economy, the types of products and services that are needed at the farm gate, where agriculture is headed, where the size and scale of farming is headed. Are those still the same problems today that the farmers had back 50, 75, 100, 125 years ago? Will they be the same problems tomorrow? And as you think about that, we have to ask ourselves, what does that say about the conventional multi-line co-op and its suitability? The one that we know today, its suitability for tomorrow. Now, my point isn't that the people who built the cooperative model were wrong. The point is that they built it for a world that has materially changed. And the institution, as a concept and as a practice, I don't think has kept pace. So I don't mean to be excessively provocative here. The co-op didn't fail. I believe it just has stopped evolving, or has stopped evolving at a pace commensurate with the conditions in which it operates. And in a competitive environment, those two things eventually look the same. And that's the idea we're going to explore today. And we're going to explore over the next several weeks, namely what we think about the co-op of tomorrow. How does it differ from the co-op of today? If so, how? And how effective, or how might the model need to evolve in order to be effective in meeting those needs? So before we jump into today's discussion, thank you as always for tuning into the program. A quick reminder to like and subscribe to the Pacesetter Pod wherever you get your podcasts. You can leave us a review on your platform of choice. Let us know how we're doing. It's the best way you can support the program, and it doesn't cost you a thing. So let's talk first about what has changed. Well, first and foremost, I think the farmer has evolved. I'm not convinced that the co-op has evolved, again, at the same pace that the farmer has. Think about a modern, sophisticated producer's business. I mean, they are running what is effectively a mid-size agribusiness. They have precision inputs. They have data-driven decisions within their business. They have pretty complex balance sheets. They probably have multi-entity structures. If they're forward-looking, they've got succession planning processes in place. They probably have some off-farm income that gets factored in. They might be providing third-party services with trucks that aren't utilized outside of harvest. They might be renting out some of their application equipment. Their labor profile can be pretty complex seasonally. They probably have contracted acres under production. They are not the farmer that the co-op was designed to serve, right? And in many cases, the conventional multi-line cooperative is still showing up with the same value proposition that it offered their grandparents. And I think it's worth exploring, kind of walking through where the specific daylight has opened up between what the farmer needs now versus what it was designed to serve, what the co-op is designed to serve. Think about, the fact that the co-op's agronomic offer, broadly speaking, this is going to be different, of course, in individual participants in the market, but the agronomic offer is largely still bundled with product sales, right? We make a recommendation. That recommendation is probably going to be constrained by the types of products that we retail. And so there's kind of this conflict of interest baked in that, I think without malintent will narrow the distribution of different formulations and products that'll be available to that producer. The grain desk offers basis and as a means for incenting or disincenting bushels to market, and it offers storage. It may or may not offer strategic marketing advice and some sophisticated risk management instruments and structures. The co-op's financial relationship with the member is still transactional. It's not advisory. It doesn't always extend into additional sort of needs and areas around, financial literacy for their members. Doesn't necessarily talk about succession planning, transition planning. Again, episodically, there might be some co-ops that are doing this, but writ large, that's an area of opportunity. And then most notoriously, the physical footprint of the co-op was built up around where the assets needed to be. And that may not, and in many cases is not, where the farmer needs the partner to show up today. So the uncomfortable reality we have to confront is that the co-op's most sophisticated members, and by sophisticated I mean the ones with the most volume, the most influence, and because of that, the most options, they're often the ones that are at the least risk of finding, or at risk of finding the least value. It's not to dismiss or deprioritize the middle-sized growers, the smaller growers, but they're on the same trajectory. They're going to become more sophisticated over time too. So the problem will just compound with time. Think about these large, what I'm calling sophisticated operations. They may have private agronomists. They probably have a grain marketing advisor, someone they talk to. That's not necessarily your merchant or your originator in your co-op. They may even be looking at direct relationships with input manufacturers, depending on the scale of their operations. They almost certainly have ample on-farm storage and a variety of rolling stock, such that if you actually pan back, they probably look like a smaller co-op not that long ago. And I think that leaves cooperatives increasingly serving the middle and the marginal, important segments, but shrinking segments in the marketplace. So if the co-op is really, over time, becoming relevant and meaningful to a smaller and smaller subset of the marketplace, that might be all the proof you need that something needs to change. So how have we handled this, historically, or even over the last, let's say, 20 to 30 years? And the trend goes back even further than that, but we'll take the more recent past. In many cases, consolidation was the answer, right? You merge with your neighbor, you achieve the scale, you achieve the capital efficiency and the cost synergies to sort of be able to stay running ahead of where the market is going, right? My wife is a teacher. She's taught middle school for years. She now teaches high school. And she said one of the dirty little secrets of being an educator is, of course, you need to know the content. Of course, you know the curriculum. Of course, you know the arc of the class and what you're going to cover in a semester or in a given year. But that's kind of the big long-term view. What do you need to do tactically? Man, if nothing else, you always stay one chapter ahead of the kids, right? You don't let the kids catch up to you in the book. And that's kind of, I think there's a parallel there with consolidation. That's the preeminent way co-ops evolved. They got larger. And they didn't do that through organic growth, through innovating on the services they provided. They did that through scale. Again, scale through consolidating other existing entities into fewer and fewer larger, arguably, maybe not always, more efficient entities.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
Mergers have been a growth engine for the industry. They've also, though, been a pressure relief valve simultaneously. Acquiring or merging with your neighboring co-op, it adds volume, it spreads out fixed costs. Like I said, it provides some cost efficiencies and some synergies, and it oftentimes delays the harder strategic questions, like the one that we're confronting now. And the model of mergers as a proxy for growth, it has worked, and it will work until it doesn't. And I think we're starting to see the logical conclusions of where it can be an effective strategy writ large. And that's the uncomfortable reality I want to confront here. Consolidation has natural limits. There are fewer needle movers that remain in the marketplace. The business cases for a merger are getting thinner, right? The integration costs are higher as more of these companies become more tech-enabled, and the technology kind of gets embedded in the different workflows and in the way you interact with the marketplace and the way you gather, you aggregate, you analyze, you maintain data. All the things that we do to bring entities together just become more costly and more complex and create more risk of customer churn, supplier friction, all things that basically dilute the value of the merger. And critically, consolidating two co-ops that are both somewhat drifting from member relevance. So if we kind of take the scenario of two smaller to lower middle market co-ops that maybe are finding themselves over time competing more and more vigorously for the small to middle size operation because they're less relevant to the larger sophisticated operators, merging two that have that same problem doesn't fix the problem. It just consolidates that marginal market. It doesn't solve a relevance issue. It doesn't solve an effectiveness issue. It doesn't solve a value proposition that fits the market issue. It produces a larger version of the same problem, now with a higher cost structure through integration and probably a more complex organizational chart. And then all the long tail drag and issues that we see with mergers. So again, consolidation was a rational and effective response to shifting conditions. But I think now, as we sit here in 2026 and in the years ahead, being myopically focused on consolidation as a means of growth is actually a means of avoiding a very uncomfortable strategic conversation. To be clear, we're not talking about the death of the co-op here. What I want to do is look at a fundamentally different operating model that returns to the original purpose of what the co-op was meant to do, but perhaps delivers that by different means. So again, I want to be clear. I think the original purpose is still valid. It's just the vehicle that needs to change. In our industry, and at the level that you are all at, those of you that are listening to this show, we need to be forward thinking while we sit in the discomfort of this diagnosis. The cooperative principle is sound. We want to aggregate demand. We want to have some shared access and market access via infrastructure. We want to distribute the returns, distribute the shared prosperity. We want to have local ownership of our supply chains. We want to have accountability to the people that are running it. None of that is wrong. What's worth questioning is whether the assets the co-op has historically owned are still the right infrastructure for delivering on that principle. What if the co-op's job going forward is to own the intelligence, the relationships, the market access that's embedded in how we can meet that need today? And then they contract out, outsource, or eliminate everything else. What if they went to an asset light or even an asset-free model? I'm not talking about people assets. I'm not talking about technology assets. I'm talking about physical brick and mortar assets. What if the model is one where you leverage a distributed network of on-farm storage that your members already own as a way of aggregating that local production, that local supply to meet far-off demand? What if the agronomic value the co-op provides isn't in the product you sell, but in the recommendation you make that's not paired with a product sale? In a capital, what if you have a capital efficient model of mixing and distributing and applying products in the field only to those who need those services, and you do so through a series of third-party partnerships? Sounds a bit risky, sounds a bit uncomfortable, but just think about the capital efficiency again of that mixing, that logistical distribution, the application, the reapplies, things that happen in the field where products moving across the road, where there's someone sit behind the wheel of a vehicle, that those were done with external partners. And you were actually that intelligence layer that sat between that logistical partner and the actual customer. So you kind of get a flavor of where I'm going with this. And so here's what we're going to do over the next several weeks. I want to start to think about, let's construct a different business model for the co-op. Guaranteed we won't get it right. So let's set expectations appropriately. There's 0% chance that we get this 100% right. But I think it's a pretty interesting and relevant thought experiment to say, what would a different business model do? Staying rooted in that original problem that we wanted to solve. Knowing that the way that you solve it, the contours of that solution look different for a farmer in 2026 than it looked in 1926. I want to then confront the constraints, the constraints to making that happen, right? What gets in the way? And it's not going to be the constraint that you're probably thinking of right now. It's not the resistance to change. It's something much more fundamental in how the model becomes sustainable. And then I want us to honestly assess whether getting there is even possible. And if it is possible, at what risk and what cost? Because ultimately, that's what we'll all need to struggle with. We might be able to see the solution. We might even be able to see a path to getting there. But it's not going to be risk-free. It's not going to be out with friction and pain. And it's probably not without significant cost to the first one that goes through the wall. And so I don't want to dismiss that. I don't want to downplay that. I want us to really, lean into that and talk about that. So as we wrap up it today, a spoiler alert for the next several weeks. I'm envisioning a 4-part mini-series here on the asset light co-op of the future. It might end up being more episodes over time, but that's where we're at right now. You're learning alongside me. But, again, a spoiler here is I don't expect we're going to resolve this tension that I perceive. We all know this is a complex problem. I believe we all have genuine curiosity around what a solution to the problem might look like. And I don't want to hamstring myself by not talking about this until I think I have a silver answer sitting here in my office, imagining all the different scenarios, waiting until we have perfection before we take action. No, I want to open up a conversation. I'm hoping you all will participate. I'm hoping you all will share your points of view and your perspectives. That's what will create the richest debate here. And I want to think about this out loud. I'm going to posit ideas. I want to provoke thoughts. I want to generate responses. And I don't care if it's generating enthusiasm, that's great. If it's dissent, it's probably going to be both. This is the kind of tabletop experimentation that we need to be doing to advance our thinking and to promote action taking in the industry. The folks who are listening to this show are the folks that can actually put your fingerprints on what the co-op of the future looks like within your organization. You have access to the board. You've got access and authority and influence with the internal management team and the staff of the organization. You interact with the growers. You're on the front lines. You know what the market requires. There's no one coming to save us. We're going to have to work on this together. And so this is going to be one little small part that I hope that we can play in doing so. Reminder, this will be a series of discussions. Today's not a standalone, so I hope that you will tune in next week. And as we go through this journey, I would encourage you, don't wait until it's all done. We're recording these as we go, as we release them. Reach out by email, reach out through our website, direct message me on LinkedIn. Everything's in the show notes. I'd love for you to share your thoughts on the matter. Of course, as always, where you think we had something interesting to say that was novel or new, that's fun to hear. But more importantly, where you think our observations were incomplete or outright wrong. The more you all engage, the richer the conversation will be, the better the content will be, the better impact we can all have. Thank you, as always, for tuning in today. I appreciate you being part of the Pacesetter community and your commitment to turning strategy into outcomes in your agribusiness. This will be a fun next several weeks. I'm glad you're along for the journey. And we'll talk to you next time right here on the Pacesetter Pod.
This is the podcastfactory.com.